Getting straight to the point, here is why having an emergency fund in cash or savings is suboptimal in 2024. There's lots of financial advice that I question, but I think this one in particular really needs to be brought into the spotlight. Financial advisors recommend having 3 months and up to a year of liquid savings as an emergency fund, either in cash or in savings. Now, having a capital safety net like this as an emergency fund is perfectly fine. The issue is that cash and savings accounts don't really do much for you in the long term. They just sit there, and as a matter of fact, due to inflation, the purchasing power of that money you have in savings and cash actually goes down over time. The reason is inflation, and it's historically been about 2.5% over the last 30 years, and nowadays it's about 3% expected going forward. Let's look at 10 years ago from 2023. So in 2013, $100 back then is worth about $130 today. Let's say you buy $100 worth of household goods in 2013. In 2023, you would need $130 just to buy the same amount of goods. So this means that the value of your money or the purchasing power goes down over time. You need more money to buy the same amount of stuff. Plus, your living expenses are gonna get higher if you get married, you have kids, have a mortgage, etc. This $130 example gets even more extreme if we look back 20 years ago. 20 years ago, if you bought $100 worth of stuff, that would cost you $160 today, and 30 years ago, that would cost you $210 today. Inflation has a significant impact on purchasing power, and that is one reason why having cash is not a good idea. Having like 1 to 1.5 months of cushion is great, because less than that, you're probably gonna risk withdrawal fees from an ATM. Now that we've gone over cash, the next natural question is, what about a savings account? Savings accounts do pay interest, but standard savings accounts actually pay next to nothing. The average rates can be from 0% to like 0.5% per year. That is less than inflation, and the return from the savings account is so low that it's basically like cash. A footnote here is actually high yield savings accounts, and high yield savings accounts right now actually pay like 5% interest in some cases, and this is a temporary thing. The rate of savings will change over time based on the federal funds rate. You can see a graph of the federal funds rate over time, and the interest rate of a high yield savings account actually follows the trend of this FFR pretty closely. So you can see in some periods that you get like a 5% yield on your cash, which that is awesome. But a lot of the times it's next to nothing. In certain times like today, having a high yield savings account is okay and actually pretty good. The issue is that a lot of times it's not 5% and it's next to nothing. And a lot of times you can see here, it's actually less than that of inflation. The federal funds rate is the red line and inflation is the blue line. When the federal funds rate, the red line, is higher than that blue line, that means that the interest rate is higher than inflation, so you are actually getting increasing purchasing power. When the federal interest rate drops below inflation, that means you're going to be losing purchasing power. You can subtract the inflation rate from the interest rate to kind of see what your real return is. Because the interest rate fluctuates and we're actually expecting it to go down in the economy right now, a high yield savings account, while good right now, probably isn't the best idea long term. That alone sounds daunting to me, but it's not even the main reason that emergency funds in savings and cash are suboptimal. The real cost here comes from the opportunity cost of not investing that money. Now remember, you only tap into your emergency fund if you lose your job or there's another emergency reason you need to draw from it. Most of the time that fund is just sitting there and you don't really need to use it. Since you're not using it, it's best to invest that money into the market and build wealth. Wealth is pretty important, especially at retirement, and you're probably going to need about $2.5 million to comfortably retire. You can build substantial wealth by earning a lot of money during your lifetime, but you can also get a lot from investing into the market. Even the highest compensated athletes, celebrities, and business people need to consider wealth and their finances, otherwise they risk going broke. Keeping your emergency fund in cash or savings account is going to compromise your ability to build wealth long term, because that money is just sitting there, not doing anything, and actually losing money given the inflationary effect. Although investing in the S&P is risky, it has historically returned about 10%. Despite market downturns, the market has always recovered. Even if you invested in the top of the tech bubble in the late 90s, which is arguably one of the worst times to invest, and you held your money all the way through the downturn of COVID, you would still make 3 times your money. And if you want to limit risk and diversify, you can always invest in bonds and REITs as well, which have historically returned pretty well. Bonds being a little bit lower than the S&P and REITs being being comparable with the S&P. I'd recommend investing your emergency fund into a market ETF of the S&P, and if you're a little bit more worried about a risk in the future, you can always switch over to bonds. Let's do a counterexample here. So suppose you invest your $100 emergency fund into the market rather than keeping it in cash or a savings account, and we'll assume that the S&P returns 10%. Now, adjusting these numbers for inflation, 10 years from now, that $100 would be worth $196. In 20 years, that would be worth about $386. And in 30 years, that would be worth about $761. In 2054, you could buy almost 8 times as much goods as you could with that $100 just by investing the money and accounting for inflation. Now, there are some risks with having your emergency fund in riskier assets like stocks and bonds. The market has historically dropped significantly, but like I mentioned, it has always come back over the long term. Given that backdrop, I think it's important to have a capital cushion. That means you invest a little bit more money than what you need for your emergency fund, and if the market drops, you have that cushion, so you still have that $100. Let's say we want a 20% cushion to assume that the market might drop 20%, and that way we would still be safe. We basically would take 100 divided by 1 minus 20%, which is 125. The point is that all of your capital, even your emergency fund, will go towards building that wealth. There's a good chance you won't use your emergency fund, so you might as well invest it and add towards that total at retirement. In summary, building long-term wealth is super important, and it's probably going to take more than you think you need to retire. It's good to have maybe 1 to 1.5 months of expenses in cash because you never know what's going to come up month to month. If you have any thoughts, please let me know in the comments, and if you enjoyed the video, like and subscribe if you want, and hope you all have a great rest of your day.